Welcome, Lexington family. Frankie DiAntonio, founder and CEO of Lexington Capital, as well as our sister company, Lexington Estates. Here to talk to you guys today about the three types of real estate investors. All right, so there's literally only three different types of ways that you can invest in real estate. Number one is going to be wholesaling real estate. Number two is going to be fixing and flipping. And number three is going to be buying and holding. So I'm going to essentially break down each of them for you guys here today. And if you have any questions, just drop some comments below. I'd be more than happy to answer them for you. So number one and first and foremost are going to be wholesalers. Now, what is wholesaling? So essentially, wholesaling is all about sales and marketing, right? So essentially, you're going out and you're finding either a distressed homeowner or you're finding a distressed home. So what do I mean by that? Either a homeowner that might be going through a divorce, maybe they're going through pre-foreclosure, maybe they inherit a property, maybe they're a landlord and they don't want to be a landlord anymore. They've had bad things happen to them, like tenants not paying them, having to evict people, yada, yada, yada. Or maybe the home just has foundation issues, there's roof issues, it's leaking, there's mold, the kitchen's all messed up, whatever the case may be. And essentially what the wholesaler does is they lock the contract up for a certain price, right? So say they lock the home up for $250,000. They then resell and flip the contract to a fix and flipper or a buy and hold investor for say $300,000. And then at the closing table, the wholesale company is then wired $50,000 to their account and the $250,000 is then wired to the homeowner, right? And they would then keep the $50,000 spread, the wholesaler. So that's essentially all wholesaling is. It's just marketing, selling, locking up contracts, and then flipping those contracts to either a fix and flip investor or a buy and hold investor. Now, the second investor is going to be a fix and flipper. So a fix and flipper, what they're doing is essentially the same thing, is they're finding either a distressed home or someone in a distressed situation. They're finding a home for cheap. They're buying the home cash, either with a hard money loan or just with cash that they have saved up. They're renovating the home, so they're maybe fixing up the kitchen, fixing up the bathrooms, putting a new roof on, installing new windows, just building sweat equity inside of the home to make it worth more than what they paid for it. And then they're then reselling it on the open market, on the MLS, on Zillow, Realtor.com, Redfin, all those websites, and then selling it for a premium. So say they buy the home for, I don't know, $200,000. They then put $50,000 worth of work into the home. They're now $250,000 in, right? Now they might have some holding costs, paying the mortgage, paying the property taxes, paying utilities for a few months. Say after all that, they're in for $280,000 and they reflip the property for $380,000 on Zillow. They now make $100,000 spread. So that's essentially what a fix and flipper is essentially all they're doing is they're finding a distressed home. They're building sweat equity in the home by fixing it and renovating it. Because essentially what you want to do is for every dollar that you put into a home, you want to be able to get $2 out of it. That's kind of like the golden rule for fix and flipping. And they then sell it on the open market with a real estate agent, just the traditional way, and they're then keeping the spread on the deal. And the third and final real estate investor is going to be buy and hold investors. All right. So a buy and hold investor is kind of doing the same exact thing. So they're finding a distressed property, right? Not usually as distressed as a fix and flipper because they don't want to put as much work in, but they're finding a home that needs a little bit of work. They're fixing it up just a little bit, not as much as the fix and flipper. They're not putting like as nice of touches on the home, if that makes sense, as a fix and flipper would, because they're not reselling it on the open market for a premium. What they're doing once they fix it up is they're then renting it out to the public, right? So they're buying a home. They're renovating it slightly, not as much as a fix and flipper would, just enough for it to be inhabitable, right? Just modern enough, not newly renovated, but modern is the key word here. And they're then renting it out to somebody, and they're then hopefully cash flowing on that property. So say maybe their mortgage is about $2,000, they're renting the home out for $2,500, and they're making $500 a month on passive cash flow every single month. And those are going to be the three different types of real estate investors. Remember, guys, going to be wholesalers, fix and flippers, buy and hold investors. If you guys have any questions, like I said before, please drop them below. I'd be more than happy to answer anything for you guys. Appreciate you guys. Thank you all so much.